Today, I would like to talk about a strategy to generate around a 4,000 US dollar per month dividend strategy. Let's see the breakdown. So, in this portfolio, there are five ETFs. So, there are two of them which are Bitcoin related, which is the BTCI and CONY. So the bottom three, PRTY, NYD, NVDY, and CONY, these are YieldMax cover call ETFs. And the top two are the NEOS. So there's a reason why I would like to combine these two different set of funds. But just let's look at the basic stats first, right? So in this portfolio, right, I would like to roughly say invest around over $90,000, right? So this is June. So it was invested 93,000, and then the percentage of investment is in this column, this K column. So NVDY has the largest percentage, which is over 62% of the portfolio. But for that month, it only generated 51% of the dividends, which is the underperformance of NVDY. Um, so for that month, it roughly generated 1,500 USD from NVDY. But we can actually take a look at the ratio. So for all of these funds, they actually outperform under this dividend price ratio. So for the highest is PLTY. So for every cost dollar, it generated the most dividend, right? Um, so therefore, for PLTY, when it had 21% of the portfolio, but it generated 27% of the dividend, which is a high achiever for that month. So we know for these YieldMax funds, their goal are mostly to give you highest income for that month possible, right? But there's also a drawback for that for those kind of funds, which is known, which are they might incur NAV erosion, which means that when the market is not doing well, their stock price, their fund price actually would suffer significantly. So that's why I also include a capital gain column for that matter to measure the overall health of the dividend fund. So, so this total return column just measures the accumulate accumulated dividends plus the capital gain as well. So we can see that for the month of June, actually CONY was the most victim for that month, which is around negative 4,000, right? And then um, the reason why PLTY also had the plus for over 4,000 total return is because before the ex dividend day that month, I also sold that fund completely for 22,500 gain, capital gain. So that's why you can see that, um, for my total return, I actually added this this sale, right? But then for this column capital gain, mostly it measures the the month end price versus the cost, the price that I bought. So which is the current price versus the bought price. So you can see that for that month it was actually lower than what I bought. But then it doesn't matter because I made capital gain of to over 2,500 for that month. So therefore, for overall return, I actually had the over 4,000 positive. And you can also see that NVDY, it's also a negative return for the total return because the current price for that month was also significantly lower than the price that I bought. Even though, it's actually giving the most dividends for that month. So June was the first month that I started to buy the NEO dividend funds, which are the BTCI and QQQI. So over this column, I also calculated the dividends versus the cost, the the investment cost that I had, right? So you can see that so it's basically the dividends over the total cost um, that I that I had, right? So you can see that actually the BTCI is twice as much as QQQI. The reason why I bought these two funds is because their stable performance under the worst market crash. So you can take a look at BTCI here, right? So you can see that for the worst market in April, it's just very minor changes, right? Like under 10%, like basically 5.7% change from before, right? Or maybe like around that. So like a 1.25 dividends per share versus like 1.57 per share. So therefore it doesn't fluctuate as much in terms of dividend performance when the market was bad or when market crashed. So this is the reason why I started to accumulate it for the bad times. So to kind of, average out my portfolio volatility in the good times versus the bad times. Um, the same thing for QQQI, right? So you can see that it's roughly stayed around the acceptable range, right? In the April month, it was 0.53, and when in the better month, it was 0.62. So it was only like a zero point 0.1 difference, roughly, right? So, which is quite stable in the market crash, right? So, but then the reason why I chose BTCI much over QQQI is because the even though it averages out the dividend over the good times and the bad times, but the total amount is not so much, right? So it's still much lower in terms of income um, compared to other dividend funds. So therefore, if your goal is to want to still um, optimize your monthly income. So I would not raise the percentage of QQQI too much, even though it averages out over the bad times and the good times. So therefore, um, I started to accumulate BTCI, QQQI, but I would actually raise the percentage of my portfolio of BTCI first over QQQI. So that's my plan. So today, PLTY and NVDY just announced their July dividends, right? Um, so for PLTY, it's giving 2.56 per share dividends, which is quite disappointing for some of the people. Um, but then NVDY, because of the past month really strong performance of the underlying Nvidia stock, so therefore it raised the dividend per share to 1.0285 per share. So, which is good. So you can see that NVDY dividends almost double of the dividends from June, right? So therefore, you can see that my actually because I actually increased because I started to accumulate the investment on BTCI. So my July investment had around $3,000 increase from my June portfolio, right? But so therefore the NVDY percentage in my portfolio actually dropped around 2% to 61%. But the well, I mean, we haven't got the announcement from CONY. I would speculate that it would have a increase for this month as well because of the past month's strong performance of coin, Bitcoin related Coinbase stock. But so, but then given, let's assume that Coney stayed the same as June, but CNBDY actually had a much larger um, ratio over the dividends, now to 66% of all the dividends, right? So then NVDY actually became a high achiever. As long as the percentage of the dividends is higher than the percentage of my investment, then it does better than it should, right? It should have. So, but then you can see that PLTY actually had the performance drop, right? So now it's lower. The dividend ratio is lower than the cost ratio, than the portfolio ratio, right? So, therefore, um, I came up a strategy to my final plan, right? So this is the bottom one is my final plan. Um, which is okay. Actually, let us finish the total return measurement as well. So you can see that in June, I still have negative $822 overall, combining the dividend and the capital erosion, right? But then in June, I already actually have a over 6,600 gain in total return, thanks to the good not only the dividend increase, but also the strong performance of the underlying stock of Nvidia and also Bitcoin, right? And Coinbase. So you can see that the Coney fund stock price actually had like almost $2 gain, right, per share. And also also there's a good big increase of Palantir's underlying performance as well. So PLTY also had the gain in price as well as NVIDIA, NVDY, right? So therefore that boosts my capital gain performance, right? Capital gain loss. So right now, um, for all of these three, I had gains as well as the BTCI and also the QQQI, right? So, um, but let's just try to prepare for the bad times when we are still in good times, right? So, therefore, these two sets of funds, they're for different purposes. So, the BTCI and QQQI, they have better tax implication because they have less return on capital, which means that so they have less also NAV erosion, right? So it's not like, they're trying to take your money and give it back to you month, right, as a distribution, but then they try to actually in the dividends or the distribution that they give you, they try to give you more in terms of income. So that's one purpose why I chose these two is for the return on investment versus the income ratio in the distribution that they give you. So that's better for tax purposes. The other one is for the stable performance when market crashes, right? So these two are more relatively stable than these YieldMax ones. Even though these YieldMax ones, they can do very well in the good times, right? But then in the bad times, in the market crash, they really fluctuated a lot, and then they will also suffer significantly in their stock prices. So that you will suffer a lot in the capital gain, in the NAV erosion, right? So, which means that your total return will suffer a lot. And then these are not ideal for tax purposes, right, as well, because like it, so therefore, I would like to combine these two. Um, but so therefore, so when if we look at the bad times in the market, um, I would like if you would still like to stick with these yield max funds, right? I would actually still choose those funds that has better, more resistant underlying stock, right? Which means that even though in the bad times, when the market crash, when the stock price crash, you will suffer a big capital erosion, but because of the strong underlying stocks fundamentals, it will still come back in the good times because we know American stock market, it's long bulls but short bears, right? So therefore, give it enough time, the capital erosion will probably um, come back and recover. So therefore, these stocks are probably going to come back after that crash. That's what we see here for the NVDY, CONY. I'm not so sure about PRTY, even though a lot of people are really rooting for it. But then because I'm not sure, like, say, give it like enough test in time, will it still be standing here strong and solid as Nvidia? So I think Nvidia will be here strong for sure, at least for the next 5 to 10 years. Right? It's not really going anywhere. So therefore, if even though there's a temporary market crash, you see a big net capital erosion, but give it time, and NVDY will come back in to recover the capital loss, right? So I'm not gonna be too worried for that. So therefore, in my final strategy, I will still keep the 35% of all of my portfolio investment in NVDY. And then also for Bitcoin, BTCI, I actually like this fund for now because first, it's relatively stable in different times of the market. Secondly, it also gives pretty good monthly income as well, right? So it has kind of like a good from both world. So therefore, I also give it another 35% of my entire investment portfolio, right? But then PLTY, because I'm not too certain about this fund, so I actually dropped it to 10% of my portfolio. And then for CONY, I also dropped it to CONY, but I might actually change the percentage of CONY because I think for a near future, Bitcoin is going to do really well with the crypto policies from the current American administration. So I might raise the percentage of this CONY, um, depending, if we keep tracking for a few more months of the performance and also the dividend from these 5 funds. So if I were to raise the percentage of Coney, I'll probably drop the PLTY and a little bit from BTCI, right? So depends on the performance of this month's Coney dividends, which will probably happen on 24th of July. And then so after we set this strategy, this portfolio, this ratio for the worst case scenario. So I use the dividends for April 2025 to to be a reference for the worst case scenario when market crash, right? And then we can see that it's roughly 2,800 US dollar per month for that month if we have 100,000 portfolio investment for the worst market case. So for now, my plan will just to increase um, the dividend every month to increase the investment on BTCI. So for every month, I'm planning to add $1,000 into the portfolio for BTCI for now, and then I will keep the rest intact for now, but just to raise the ratio of my BTCI first to 35%, and then I will start dropping the other funds ratio to my goal ratio percentage here. So, okay, so for next month, we will see how it performs, and then I will give you an update on the portfolio performance. Thanks for watching. Bye.